Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Pederson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Pederson. So today I have with me Martin Saenz with BeQuest Funds. How you doing, Martin?
Good, Lance. Thanks for having me on.
Yeah, pleasure's mine. So BeQuest Funds is a recent new member for the Verivest Sponsor Network. So, as one of you know, my day job over at Verivest. And so we're excited to have these guys on board, and we've got to spend a little bit of time with them and learn more about their strategy, which we'll be sharing with you guys today. So looking forward to this, and then we're going to have Martin's partner Sean on to kind of talk about another segment of their business, which I think is an interesting strategy. It's been around for a long time, but it's sort of, when you put it all together, it's a great way to generate ongoing income, and sort of solves a problem that our investment portfolios have, which is we need income in our portfolio, and it happens to do that. But how it happens and how it works is a very laborious process to sort of make that happen. So we'll dive into that here in a little bit. But Martin, why don't you share with us sort of how you ended up getting into the real estate and note buying business? What was sort of your background, and really what led to you deciding to launch and start BeQuest Funds?
Sure. So I took the hard way to get there, just so you know. But just to kind of start things off, I get out of school with my MBA in 2001, and I got a corporate job. And that was kind of the whole goal, was to get the safe and secure job. And what I found after a few years of working in corporate America is I was really bad at it. Yeah, I was the politics, the just kind of taking direction from numerous bosses. It wasn't my cup of tea. And fortunately, I was fired. And from that, my wife and I really just decided that we needed to start our own company and take the business route. And so from that point, we started a government contracting company that sold to the federal government. And what I found with small business ownership is that it's very taxing time-wise and dollar-wise. Took 3 years of being beyond broke to really kind of break through. And so we made all the mistakes and had all the trials that most small business owners have. Making payroll day of, paying bills with credit cards where you didn't have the money to pay the credit cards, and so on. So through that time period in the mid 2000s. I even fell behind on my mortgage, actually, of all things, right? For about a year, and tried to get in touch with my lender. It was a major lender. They wouldn't talk to me. They wouldn't do anything for me. They wouldn't even help me, get back to terms with them. I would mail them monthly payments, and they would mail them back to me because it wasn't full reinstatement, et cetera, et cetera. But
Right.
Long story short is the business turned a corner. And we bought a building by which we moved the company to. I bought the neighboring building. I paid off the mortgage with cash, and just started buying real estate. And what I found with real estate and landlording, which I still do today, and still have the portfolio today, is it didn't provide the amount of cash flow I was seeking to meet my aspirations. So fast forward 2013, my wife and I sold the company, and just kind of looked into what the newest venture would be.
Got it. Yeah, that's a great story. So you've you've sort of been in a position that many of the borrowers that we'll talk about here in a minute, sort of that foreshadowing that you dropped in there. But I agree with you, right? Like being an entrepreneur, I mean, similar to you, right? Like my parents were small business owners and entrepreneurs. I knew nothing different growing up. And same thing when I went out and, got into the real world and got a job. I learned pretty quick that I was not cut out to be an employee. It's just a different animal, right? So much like you sort of set out and said, well, just do it on my own then. But yeah, it's a tough gig to get these things off the ground and takes a lot of grit. And it's interesting you point out too, even for you guys then, after selling the business, then it's sort of like, okay, now what, right? Like how can we, have the lifestyle? I think something similar between Martin and I before the show, he shared that he has 4 little ones. We've got 5 children. Ours are a little older than Martin's, but you do realize just how valuable your time is. And so I think those are some of the things we'll get into today. So now with the BeQuest Funds, you guys are ostensibly, you've got an investment vehicle that's purchasing these notes and mortgages, right, and sort of pooling them together then to deliver an income stream to passive investors. So that next thing was sort of getting into that game, which is, you're a published author and you've written books about this, but how did you bump into that, right? Like, so how did you go from, hey, we got this government contracting business, and we sell it, and you've got a real estate portfolio that's generating passive income. How do you end up getting into the note game?
Yeah. So I knew when we sold the company that I needed to move towards obtaining freedom of time versus financial freedom. Financial freedom, it kind of left me with a lot of hours worked. So I said, I need to build time in my life. And at that time in 2013, I also formed a relationship with God. And so I became, I worked on my spirituality as well. And that was kind of a changing point for myself where I said, I want to work to serve others. So I went from this whole thing of like, I want to work for dollars and cents. And I would have a vision board with a yacht and, I'd have all these multi-million dollar things. The things that I thought, represented happiness. And in 2013, I just realized, no, what I need is I need to know myself. I need a relationship with a higher power. I needed to serve others. And so when I made that decision, it really just kind of transformed my outlook. And I was at a local RIA, a real estate club, and I ran into a mass note training kind of operation. And I took that class, and it was really transformative for me because it kind of put pieces together. Pieces where I could start a business for myself. I could. It's in the real estate asset class, and I could work with homeowners and create payment plans and other creative solutions with them. So I was really all in. However, the program itself wasn't for me. I respect what they do, and they're a well-respected operation, but it just wasn't for me, and it was probably based on arrogance. If I have to kind of look back at it, I thought, hey, I'm a big bad business owner. I've paid my dues. I'm this big time landlord, so I'll figure this out. Right. So I don't need to kind of progress training anymore. So I self-taught myself, which basically means I got hammered by buying, a lot of bad notes and doing all the wrong things. But I quickly honed my due diligence process, and I really learned how to form the right relationships in the secondary space where you buy these mortgage loans. And through about an 18-month learning curve process, I really got off the ground with understanding what my mission was for my operation, and going full force and as with acquiring as many assets as I can acquire.
Yeah. So for you, you've got Sean, who spends, at least at the BeQuest Funds level at this point in time, is more of the acquisition guy. So he's digging through these pools of notes and those sorts of things. And then your sort of running point on, working them out and working with borrowers and obviously investor relations and things like that. So maybe share with us, like, what does an asset look like, right? Because I mean, I think for some people, the note buying space, I mean, a lot of people learned about it, but a lot of people don't really understand it, right? Like, how in the world does this thing work? Like, where would one, because you talk about the secondary market. I mean, obviously someone originated this loan that has this real estate collateral, usually single family home or something, and something happens and it goes sideways, and now it's sort of, scratch and dent sort of deal, right? And so what, maybe just walk us through a bit of that, and then we'll sort of hone in on the asset management side and sort of how do you work these things out, because that's obviously how you generate the value, right? If as you said, there are wrong ways to do this that can lead you to financial pain, but if you know what you're doing, it kind of changes things. So maybe share with us, like, what that means when you go out and you actually want to be a note buyer. Where do you go to look for that stuff?
Sure. So my roots are in the distressed debt space. So what that means is purchasing, acting as a hedge fund to purchase notes whereby the borrowers have not made payments in 4 or 5 years. And myself, the team of asset managers, we make outreach attempts to the homeowners and help them back on their feet with a payment plan that they can afford while making a profit for our company. So really, that's where my roots stem from. To make one distinction, BeQuest Funds houses a portfolio of seasoned performing mortgages. So it's kind of a different asset class, because I've worked both ends, both the defaulted mortgage loans where the borrowers aren't paying, and as well as managing on a daily basis the performing assets to ensure that they continue to pay. So I've kind of worked the whole life cycle of it. Now, in terms of people coming into the industry, I've written a lot on that subject, and really it takes someone to form an identity. They need to understand what it is they're procuring, what's their buy box, what's their capital bandwidth, what's their bandwidth for processing due diligence, as well as managing the asset from an asset management standpoint. And then go into the marketing and outreach. It's really a daily outreach effort to source for new deal flow, especially for the first few years to really get off the ground, because it's such a tight-knit community. It's hard to break into for new players, but it's not impossible if one's willing to put in the work. But like anything else, work is the key word, and it's capitalized. And it's none of this is easy. Even passive monies needs daily monitoring and activity towards it.
Yeah. So for you guys then, are you buying them distressed through one vehicle, getting them performing, and then putting them into that performing vehicle, or how does that, how does that work? I mean, obviously you get the borrower sort of back on their feet. I mean, and maybe you can just share some of these circumstances too, just around these situations, because it seems to me, just at high level, right, it's just that these huge financial institutions, they don't have the bandwidth themselves to sort of reach out, and so these people are like, something happens, but they don't. That's sort of how it goes sideways on them, and where you guys kind of pick it up and at least make an outreach and touch them. So just give us like an example of what that looks like, of someone that you might be working with.
Yeah, so on the distress side, people default generally for 3 reasons. Love, they go through a divorce. Health-wise, something happens with their health. And employment, they lose their job or they become underemployed. And so oftentimes those occurrences, even though they maybe have long-lasting effects, they're short. They're a period of time in the borrower's life. So if we're catching them 4 or 5 years down the road from when that occurrence happened, they may be remarried again, have their health back on track, they got their old job back, and so on. So our job is to really understand what they can afford and kind of match that with the discounted purchase price that we purchased the asset for, to see if we can come to a win-win scenario whereby we give them a plan that they can afford, because if they can't afford it, they're going to stop paying, right? And then as well as meet what our IRR expectations are for our operation to cover our bills. And so that's really kind of what we look to do. However, in BeQuest, the whole idea when we created BeQuest was to make a legacy play. It's an evergreen fund. It's somewhere people can park their money and earn an 8-9% annual return and be paid on a monthly basis. And so the idea was we were going to go and select assets from our distress side, our performing assets on our distress side, and as long as they meet the underwriting criteria, move them into BeQuest so that they can be housed there. But what we found is that we wanted to build our reserve on our distress side of those performing assets to go and just kind of cover operations. And we wanted to buy reperforming loans, performing mortgages from the secondary market to place into BeQuest. So either way, however the assets come in, they go through a rigorous underwriting process that's the same.
Mm-hmm. And so the loans in the BeQuest side, what do those mortgages look like? Are they're 15-year, they're 15-year AM, 30-year AM? What kind of what's the face rate on these things? Like these are what, 6, 7, 8%? And then what kind of discounts, were they usually acquired at? I guess if they're reperforming, then it's sort of like someone else. You're still buying it as a percentage. A discount to UPB, unpaid principal balance, right?
100%. So as it stands right now, our average AM term is about 22 years. The average principal balance is somewhere around $60,000, and they generally tend to be second mortgages, junior lien mortgages. They are owner-occupied properties. The average fair market value sits about $320K. So they're good properties, typically in suburbs or tertiary markets, and they're owner-occupied properties, so there's emotional equity. But the main metric that we live by for our fund and our whole operation is investment to value. So we run our operation we like to keep under 65% investment to value for our portfolio, and our portfolio currently sits at 61% investment to value. So that's very significant in terms of capital preservation. So when we see the economic downturn, which it's going to come, we'll be able to withstand that economic downturn to the tune of 39% at this point in time.
Yeah, and then so when these loans when they end up with these junior liens, like who is usually the lender? Does this still come out of like that HELOC, like the home equity lines of credit, and where did they? Because even today, can you really even, are seconds even really being originated anymore?
Definitely not to the extent they were in the mid 2000s, for sure. A bulk of these were originated in 05 to 08 for certain. Yes.
Yeah. But they still have, so they've got 22-year AM. That's sort of so they're Well,
those are the new. So when we modify the terms of an original note, then we're gonna extend the amortization out 20, 30 years, because we're trying to we're lowering interest rates. We're doing whatever we need to do to ensure the borrower is able to afford the payment.
Got it. Yeah. So you're like you're rewriting. That's part of the workout. Is like you'll say, okay, the existing loan, we rip it up, boom, here's a new. So that's part of the process.
Yeah, and from a mathematical standpoint, it just makes sense, right? The borrower can afford to make the payment, so they're going to afford it. But there's something deeper to that. We as a company culture, we pound on the fact that the borrowers are our customers, and we're doing everything possible to ensure customer satisfaction. And the more we do that, the more we're gonna be first in mind when they make their monthly payment. And really,
Yeah.
that's what we're doing. We're cultivating deep-rooted relationships with our borrowers, whereby they feel very comfortable to call us with any kind of circumstance or scenario, and we're going to work with them to the the best of our ability.
So does that mean then? So you guys serve as the loan servicer of record, or do you have another group that handles sort of the payment posting? I mean, because that's a big part. I mean, I know that in this space, there's a lot of regulation around, loan servicing, which of course is hilarious because it usually results in like terrible customer, satisfaction type of stuff, right? So how does that work?
Yeah, so we employ a third-party licensed servicer to service all the debt. So they're going to send out the monthly statements. They're going to receive and borrower payments. They're going to send out year-end tax forms. But in terms of a relationship, we're going to piggyback off the licensed servicer, and we're going to be there to assist the homeowner in any possible way.
Got it. So, and is it really it's through that? I mean, once you get it reperforming, so a lot of the paper you guys you're buying now is reperforming. So I guess I'm trying to get at it seems like it could be a constraint, like having the people to, like for you guys, if you just had a flood of capital come in to place, would that be your limiting factor? It's just like you don't have enough people. I mean, you're speaking to the culture. You guys want to be about that, but it seems like at times that can be the limiting factor, the constraint in your business model is just you don't have enough people that know how to manage. You couldn't train them fast enough, or how do you deal with that?
So I'll just put it this way. During the heart of COVID, we were at a 92% collectability percentage, which is above the 90% industry standards for collectability. And so that means 9.2 people out of 10 were making their payments on time to us. Mm-hmm. And we anticipated that number going down to about 75%. So we were ready for all out chaos. And now we're sitting at about a 96% collectability percentage. So we're as long as we see the fruits of our efforts, then I have no problem staffing up to accommodate. As long as the profit margins are there and we're doing everything we can. But I'm not going to disrupt the momentum or the culture to save a buck.
Yeah. Yeah, so that's, for you guys, because that is the kind of knock on a lot of the people who do this is they're just sort of, that's just the part that they don't care. They don't, like you said, I don't think that most of them wake up and say, the borrower's our client. I don't hear that. And obviously we have quite a few, we do administration for quite a few, note funds. So I'm not knocking our existing clients.
They're paying your bills every month.
Yeah.
Right. What else, what would you define as a client? Someone that's paying your bills.
Yeah.
I don't
know.
No,
I agree. And I think that, but and that's what I mean. That's a cultural thing. It's just how you view it. It's the same with, it's the same with like if you're a multifamily, syndicator or whatever. The clients are the tenants, but I'm not saying that I just say a large percentage of them don't necessarily view them as their clients. They don't treat it that way. Especially if they hire a third-party property management firm, they sort of say, well, it's your job to do that. And I'd say that in the lending or the mortgage business, or the note business is similar. It's just that they hire the servicer. The servicer's job is to handle all that stuff, right? So I think that's the difference. Now, my assumption is that by abdicating those sorts of things, your performance is going to suffer, meaning you won't hit those collection rates. Right. Would you attribute that for you and your team? Is that how you guys make this happen is because you do view it as though the borrower is your client, and that ends up. That seems like it's part of what your strategy is, part of the secret sauce. It's a
moral obligation that we're working with the homeowners. So if we own a loan, and we're not doing everything possible to help that homeowner with a payment plan, what's happening is every day the borrower continues to be in default, there's a per diem interest rate that gets assessed to their account, as well as a monthly late fee. So they're further digging themselves into a hole on my watch, and that's unacceptable.
Yeah.
So we're it is our duty when we buy these mortgages. We're accepting that responsibility and taking it very seriously.
Yeah. No, that's great. I mean, I love hearing that. So beyond that, like, what are the other things that you guys do to sort of to mitigate the inherent risks of your business? I mean, because it is. I mean, obviously you've got the investment to value. So I guess I'm kind of curious as to how you guys keep track of the V and investment to value, the value component. Like, how do you ensure that you're sort of got your finger on the pulse of where those values of the underlying collateral might be landing?
Yeah. So my partner Sean, he's a mathematician. I mean, he's very good with numbers, and he carefully scrutinized the property valuations and also lien status and the loan balances on a collateral asset. So all those calculations are done before purchase. Mm-hmm. So we're really meticulous in terms of how we perform due diligence, and we don't automate the process. There's a lot of hedge funds that will do sample auditing of files to go and put indicative pricing out there. We actually go through each loan individually with a group of people, and each one's responsible for a different metric through the due diligence process, and we scrutinize each and every loan, before purchase. So we're careful about what comes in. But I'll tell you, Lance, if there's a secret sauce, I would attribute it to the intercommunication that goes on with our team. And we have a morning meeting every morning where everyone in the team is going to relay where they are with their KPIs, what wins they had the day prior. We have a success bell that we ring whenever a modification comes in or some other success happens. We have one-on-one meetings. We have weekly team meetings. So there's an abundance of communication whereby we all know what's expected of each other, and we're all kind of performing to that.
Yeah, no, it's great. I mean, it's funny with all these interviews I do and these episodes. It just, I mean, even in our own business, right? Like, it's always about the people, right? It's about the culture and the people and what North Star is and your mission and your purpose. And I know for some it seems like it's, fluffy, floofy, sort of stuff, but it's just, it never ceases. I mean, that's what Good to Great. I mean, Jim Collins wrote the book. I mean, you can have two companies that for all intents and purposes on the surface look to be the same type of business, and one's great and one's not. Right. And then when you dig into it, it always came down to these sorts of factors, leadership and just how you viewed what you were doing and why you were doing it. Right. The importance of those things makes the world a difference. And I know that for a show like this, I mean, we're here to talk about risk. Right. It's like, hey, you want the reward. The investor wants to put money in and get some kind of return, a return that's exceed sort of a risk-adjusted return that's great. I mean, who wouldn't want that? I mean, do you want to earn 0% interest in a money market account, or do you want to earn a 9 or 10% return, 8, 9, 10% return, and then get a check, every month or every quarter? Well, of course, I'll take that, but it's understanding that those returns aren't equal. I mean, many people could offer the same thing, but figuring out which one is less risky is sort of part of what it takes to become an investor, even when you're passive, right?
It starts with the beginning of the game.
Yeah, I mean, who are the people in it? Is it makes the world a difference.
Yeah, so I'll say this, but we hired a new gal in today. Her name's Kirsten, and she comes in and meets with me. She's going to be on my team, and first question I ask is, what are your monthly expenses? Because we need to figure out how much you need to produce here to cover your monthly expenses. Plus, what are your aspirations? We need to cover that too. So the same kind of conversation I would have with an investor is the same conversation I'd have with a team member here, because we all need to be, ensuring that we're kind of aware of where each other's at financially and making sure that we're all kind of, doing the best for each other. Now, in terms of Sean and myself, when we came into this fund, we put $1 million of our own money in. So that was really the first statement, is that we didn't want to be someone telling someone else, hey, come invest in our fund, and we don't have a nickel in it. And so, so you're talking like, someone who's not only showing up every day, putting in the work, leading the team, scrutinizing these assets prior to purchase with Sean, but we're someone that put our own money in as a co-investor, Class B shareholder. So we feel like we're all in. This is our sole focus, and so we feel, I don't know that I could say it any differently. I don't have. I'm not like a major mathematician where I could like woo you with numbers and this and that, but I'm here every day and I'm pounding it, and we're making sure the borrowers continue to pay and building that culture.
Yeah, no, it's great. Yeah, and those are the things to look for, right? And when you make these investments, is who are the people behind it, and why do they do what they do? What drives them? I mean, all the things that you've said, right? Like those are the sorts of things that you look for when you are investing your money, obviously, in this case, to someone who's executing a strategy. One, it's like the things we talk about here, is just understanding how it works, right, is sort of step one. And then two, understanding how people go about doing what they're doing, vis-a-vis what others might be doing, right? And I think that's what investing is just trying to understand. It's about the comparing and contrasting alternatives, right? For just like you guys do. I mean, that's what it is. You've got I'm assuming these loan tapes are massive and crazy, right? And there's so much stuff there, and the trick, like you said, is just figuring out how to boil it down to your buy box that meets your strategy, right? And then it's your job to construct a portfolio, right? Where's that diversification, and how can you there's a lot that goes into it. I think that it's the note business, especially. I feel like it's misunderstood by most people. I don't think they really fully appreciate just how laborious it really is, which I like to touch on these things, because for you're in it all day long, but I don't, for others and outsiders looking in, it's just not as simple as sort of, getting a loan tape, looking at it, wiring money, boarding them at the loan servicer, and then just going on vacation. That's not how it works.
Now, I will say, when I started, it used to resemble that more so. So it was, and if you had money jingling in your pocket, there would be a note seller to sell you a tape. So it used to be that way. But the way regulation is, heavy compliance in the environment, now sellers are vetting the buyers. So they want to understand your operational makeup. They want to understand what type of risk that they're assuming by selling to you. So it's a very different environment in that regard.
Yeah, no doubt about it. Cool. Well, where can people learn more about BeQuest Funds? And I know you've got a book. I'm assuming you can buy that on Amazon, or maybe just share with people where can they learn more about what you're up to, and where they can find you.
Yeah, absolutely. So you can reach out to Martin at bqfunds.com, and have myself or one of the team members send you an ebook, or you can go to Amazon and just punch up my name, Martin Saenz, and I've written 5 books in total. And the one that's the bestseller is Note Investing Made Easier. And just reach out, and any general questions, if you have any curiosity, just shoot me an email, and I'll respond back promptly.
Cool. Well, I appreciate your time, Martin. Thanks so much.
Thanks, Lance.
All right. Take care.